Welcome to Ito Analytics, the leading platform for providing volatility data and option analytics. This is Chapter 10 of Option Trading Tutorial Series. We will do some case studies on real markets in this chapter. The first case study is about put selling. The stock we are looking at is NVIDIA. As of the 31st of January 2025, NVIDIA stock was at $120. NVIDIA had some big sell-offs in last week of January 2025 due to the release of DeepSeek models. If we look at implied volatility term structure, which is at the money implied volatilities across different tenors, we can see that 1 month and 3 months implied volatilities are roughly at 95th percentile past 1 year level. And these implied volatility levels are much higher than the longer tenor implied volatilities, which are usually considered as the average level over time. This is a clear sign that short-term implied volatilities are inflated. On top of that, if we further look into skew term structure, we see similar patterns. Short-term skews are higher than long-term skews, and they are close to 95th percentile level comparing to past year data. This shows that short-term skews are inflated, meaning short-term puts are priced relatively expensive versus short-term calls. Looking into the time series data of implied volatilities, we can see that implied volatilities jumped since late January 2025. And time series data on short-term skews also showed that skew jumped in late January 2025. With observing all these movements in implied volatilities and skews, we can formulate trading strategies. If trader is bullish on NVIDIA and looking to buy NVIDIA stock at even cheaper price, trader can consider selling short-dated out of the money puts. The idea is to receive some option premiums by selling expensive put options as a way to take advantage of the inflated implied volatility and skews. To do so, we can load a few short-dated puts into Option Pricer. Here we are looking 5 out of the money puts with maturity as the 21st of February 2025. We can roughly see what are the premiums on those puts. One of the natural choices would be selling the $100 strike put. $100 is considered as a support level of NVIDIA. Also, by looking at the option specifications, this option is roughly 17% out of money, which is roughly 1 standard deviation away from current spot, estimated with current implied volatility. Recall from previous chapters, premium as percentage yield is a key metric for option selling. This NVIDIA puts premium translates to roughly at 20% annualized yield, which is considered very good as risk-free rate is roughly at 4%. One way to verify our thought would be to price the same option with different historical implied volatilities. Here we are pricing the NVIDIA February 2025 $100 put with historical market data in previous 3 Fridays. We can clearly see that option premium as of 31st of January 2025 is much higher due to expensive implied volatilities and skews. The game plan for the put seller is just to sit with the option until the maturity. If the option expires out of the money, put seller simply pockets the entire premium. If the option expires in the money, then option seller pockets the option premium and also buys NVIDIA stock at $100 on the 21st of February 2025. Also, in case NVIDIA goes up a lot after selling the put seller can consider buying back the put when the put premium becomes very small. The next case study is selling covered call. The stock we are looking at is Alibaba. As of the 31st of January 2025, Alibaba was at $98.84. Looking at implied volatility and skew term structures, we can see short-term implied volatilities are above 95th percentile versus past 1 year data and well above long-term implied volatilities. On the other hand, short-term skews are below 5th percentile and clearly below long-term skews. Further looking into time series data, implied volatility jumped and skews massive went down in late January 2025. With these movements on implied volatilities and skews, we can formulate covered call selling strategy. If trader is already holding stock on Alibaba and looking to sell the stock at higher price, then selling out of the money covered call would be the optimal strategy. Idea is to receive call premium by selling expensive call option as a way to take advantage of high implied volatility and cheap skew. Cheap skew means calls are relatively expensive versus puts. We can load up a few call options into Option Pricer and just to see what are the premiums of those calls. Maturity of our choice assumes to be the 21st of February 2025. One natural choice of strike would be $115. From specification, this call is roughly 16% out of the money, which translates to roughly 1 standard deviation away from spot. Premium as percentage yield is close to 20%, which is a very good yield versus the 4% risk-free rate. The game plan for call seller will be just to sit with the short call until the maturity. If the call expires out of the money, then call seller just pockets the entire premium and holds the Alibaba stock. If the call expires in the money, then the call seller pockets the premium and selling the Alibaba stock at $115, which is 16% above the current spot. If Alibaba goes down a lot after selling the call seller can consider buying back the call when premium gets very small. In this chapter, we study put selling and covered call selling in real markets. Selling put is suitable for having bullish view on underlying and looking to buy the underlying stock at lower price. Put selling allows traders to receive daily theta. The optimal entry point would be a high implied volatility and expensive skew market, as premium would be high for puts. On the other hand, selling covered call is suitable for traders who are already holding the underlying and looking to sell the stock at higher price. Traders can receive some theta while holding the stock and waiting for stock to go up. Optimal entry point would be a high implied volatility and cheap skew market, as premium would be high for calls. This is the end of Chapter 10. All the data, visualizations, and analytics in this chapter are from Ito Analytics Volatility Terminal. Visit Ito Analytics website to get access to Volatility Terminal.